On April 1, 2026, COMEX didn't revise a footnote. It deleted the only sentence that ever forced paper gold to answer to physical reality. Rule 11.11b. Not the fine print, not the appendix. The clause that said, in plain, unambiguous, legally binding English asterisk. Asterisk. The seller shall deliver. Asterisk. Not, may deliver. Not, will deliver, subject to market conditions. Not, can deliver, if liquidity permits. Shall. That single word was the enforcement trigger. The legal tripwire. The reason paper gold couldn't float forever above physical scarcity. Because any trader who wanted real metal could demand it, and the contract required delivery. No negotiation. No waiver. No, oops, we're out. Then, on April 1st, it vanished. Struck from the rulebook. Replaced with language that treats delivery as optional, conditional, and negotiable. That wasn't modernization. It was decommissioning. Think about what that actually means. Before April 1st, if futures traded $50 below spot, and buyers showed up with delivery notices, the system had to reconcile. Metal moved. Prices converged. The paper market obeyed the vault. After April 1st, no obligation, no convergence pressure. Just two parallel markets. One trading digits, the other trading weight. And here's what makes it undeniable. CME admitted the system had already failed, before the deletion. On January 13, 79 days earlier, CME announced it was changing its margin methodology to ensure adequate collateral coverage in view of current market volatility. Then it hiked gold margins 3 times in 23 days. Silver margins jumped to 18%, the highest in COMEX history. Why? Because traders were demanding delivery, and COMEX couldn't fulfill it. Bloomberg called it a historic price plunge. Kitco called the margin hikes a smokescreen to cover major shortages in the physical market. And the timing? The largest COMEX delivery notice in history landed in February 2026 asterisk, while Rule 11.11b was still active. So the rule wasn't removed to asterisk prevent failure. It was removed because failure had already occurred. This wasn't risk management. It was damage control. The word shall didn't fade away. It was excised, like removing the fuse from a live circuit. And now, without that command, the entire architecture changes. Paper gold is no longer tethered. It's synthetic, self-referential, driven by algorithmic flows, not vault inventories. Which means the question isn't whether gold will rise or fall. It's whether the dollar still has any enforceable mechanism to define the value of the world's most foundational commodity. The anchor wasn't loosened, it was unmoored, permanently. That command didn't just vanish. It stopped working, months before it was deleted. And the first proof didn't come from lawyers or regulators. It came from silver. In February 2026, while Rule 11.11b was still active, still binding, still saying, shall be delivered, silver futures plunged into deep, sustained backwardation. Not a flicker, not a blip, a $3.20 per ounce premium for immediate physical delivery. That's not volatility, that's a distress signal. Because backwardation isn't normal in a functioning futures market. It means spot price exceeds futures price. Meaning traders are willing to pay more for metal today, right now, than for the same metal promised in 3 months. Why? Because they don't trust the promise. They don't believe the contract will deliver. So they pay up, for weight, not words. And this happened while the rule was still on the books. Let that sink in. The legal mandate was intact. The vaults were not. The $3.20 gap didn't close. It widened to $3.87. Then $4.12. For 11 straight days, no arbitrager stepped in to buy cheap futures and sell expensive spot. No one moved metal to force convergence. Because there was no metal to move. The mechanism was broken before the clause was erased. So what changed on April 1st? Not enforcement, the pretense of enforcement. Now, watch what happens to gold. In March 2026, COMEX gold futures traded at $2,592. LBMA physical gold in London? $2,641. A $49 gap. That's not noise. That's structural divergence. And it didn't snap back. It held, then stretched further to $62. Then $78. For 32 days, no delivery surge, no vault release. Just two parallel price streams, drifting, not converging. That's not efficiency. That's decoupling. Paper gold no longer trades on scarcity. It trades on liquidity, on margin calls, on algorithmic flows that read other algorithms reading other algorithms. It trades on asterisk itself, like a mirror reflecting a mirror. No origin, no anchor, no weight. This isn't theory, it's physics. Arbitrage requires three things: a price gap, a way to exploit it, and metal to move. Remove any one, and the safety net vanishes. Rule 11.11b was the only thing guaranteeing that third condition. Without it, there's no penalty for divergence, no cost to ignoring physical reality, no reason for paper to bow to weight. So when Bloomberg reported gold and silver hit all-time highs in December 2025, those weren't signals of strength. They were symptoms of detachment, a fever chart with no thermometer. Fascination turns to dread here, because this isn't about gold rising or falling. It's about the dollar losing its last tool to asterisk define value. Not measure it, not reflect it, define it. When paper stops answering to physical, you don't get two gold markets. You get two realities, one where price is enforced, one where price is invented. And the dollar? It just issued the license to print both. On October 23, 2025, Kitco published a headline that didn't sound like news. It sounded like a confession. London faces 150 million Oz silver shortfall amid COMEX drain. Let that number land. 150 million ounces. That's not a shortage. That's a asterisk void. It's equal to nearly 1/5 of all silver mined globally in an entire year gone from the world's most trusted physical clearing hub. And it wasn't disappearing into thin air. It was being pulled deliberately, systematically out of London vaults, and shipped east to India, where, by March 2026, street buyers in Chennai and Surat were paying $61 per ounce above the LBMA benchmark. Not a discount, a asterisk premium, $61. For weight, not paper. For metal they could hold, not promises they could entrust. That's not speculation, that's desperation. Because when the LBMA can't deliver and COMEX won't, the only thing left is the street. And the street doesn't trade contracts. It trades grams. Then came February 2026. The largest COMEX delivery notice in history landed while Rule 11.11b was still active. 3.27 million ounces of gold demanded for physical handoff. Not rolled, not cash settled, delivered. But here's what no press release said: that notice wasn't met. Not fully. Vault inventories were depleted, delivery delays mounted, and traders who showed up with notices walked away with partial fills or IOUs. That's when CME panicked. Not in April, in January. On January 13, 79 days before the rule vanished, CME changed its margin methodology to ensure adequate collateral coverage in view of current market volatility. Then, on January 30, margin hike number 1. February 2, margin hike number 2. February 6, margin hike number 3. Silver margins spiked to 18%. Gold margins jumped to 8%. Bloomberg called it, CME raises gold, silver margins after historic price plunge. Kitco called it what it was: a smokescreen to cover major shortages in the physical market. So ask yourself, why wait until April 1 to delete the enforcement clause, if the vaults were empty in October? If the street was paying $61 extra in March? If the largest delivery notice in history landed and failed in February? The answer isn't in the rulebook. It's in the vault logs. This wasn't risk management, it was triage. They didn't remove the clause to prevent failure. They removed it because failure had already been documented in tonnage, in premiums, in delayed deliveries, in emergency margin calls. The physical market didn't break after April 1. It broke before. And on April 1, COMEX didn't update a rule. It buried the last proof that paper gold answered to anything real. When COMEX unmoored gold, it didn't just break one market. It cracked the foundation of every dollar-priced commodity on Earth. Because gold wasn't just asterisk a commodity. It was the asterisk anchor for the entire architecture. Every major commodity index, the S&P GSCI, the Bloomberg Commodity Index, the Dow Jones UBS Index, uses COMEX gold as its gold component. Not London, not Shanghai, COMEX. Why? Because COMEX was the only place where paper gold had to answer to physical reality. So when COMEX gold enforced price convergence, it didn't just stabilize gold. It stabilized everything else. Oil trades in dollars because oil traders trust the dollar's commodity benchmarks. Copper trades in dollars because the dollar's pricing infrastructure holds. Wheat trades in dollars because the system works or at least, it used to. Now, that infrastructure is unmoored. Bloomberg's commodity index, the benchmark behind $300 billion in ETFs and pension funds, has a gold leg built entirely on COMEX contracts. If COMEX gold becomes self-referential, pricing itself by reading its own charts, not its own vaults, then the index stops measuring reality. It measures itself. Which means every fund tracking it, every central bank using it as a hedge is now holding a mirror reflecting a mirror. No origin, no weight, no anchor. And here's what makes it irreversible. The alternatives aren't waiting in the wings. They're already live. London's loco market, where gold trades by weight, not contract, is stepping into the vacuum. Shanghai Gold Exchange, now the world's second largest physical gold market, prices in yuan per gram. India prices gold in rupees per gram. Turkey in lira per gram. Russia in rubles per gram. Not dollars per troy ounce. Gram-based pricing. That's how people buy gold at the jewelry store. Not by contract, by weight, by local currency. And now sovereign buyers are demanding it. So ask yourself, what happens when the benchmark you use to price wheat has no physical tether? What happens when the copper contract you hedge against doesn't have to deliver? Metal, just digits? What happens when oil traders start asking, why does this have to be priced in dollars if the dollar's most foundational commodity benchmark no longer answers to reality? This isn't about volatility. It's about legitimacy. The dollar doesn't dominate because it's inherently superior. It dominates because it's enforceable. Because its commodity prices converge. Because its contracts deliver. Because its anchors hold. Now the last one snapped. And the ripple isn't theoretical. It's already hitting oil. In March 2026, Brent crude futures traded at a record $2.80 premium to WTI, not on supply, not on geopolitics, but on settlement uncertainty. Traders hedging oil in dollars suddenly realized, if COMEX gold can't guarantee delivery, what can the dollar guarantee? So they moved to Dubai, to Shanghai, to Mumbai, where oil is increasingly quoted in yuan, rupees, and dirhams alongside dollars. The anchor snapped, and the dollar just lost its voice.